we've seen a rebalancing of where investors are deploying capital globally and a shift back from the US towards Europe. And I think London is benefiting a bit from that too.
The return of IPO activity in Europe, as the continent has sort of led the way. And actually, when I look at the pipeline, I look at the opportunity set, Germany will probably lead the way in the continent over the next sort of 6 to 12 months. So a lot of the successful deals that we've seen over the last 12 months have been the bigger transactions. That's all well and good, but we also need to see a recovery in the smaller and mid-cap space.
After a challenging few years, can Europe's equity capital markets reclaim their edge? Is London still a global financial powerhouse? The global economic order is changing. Investor confidence has been shaken by tariff debates and uncertain growth outlooks. For equity capital markets, one of the places that companies go to raise funds, this has led to a quiet few months. But there are signs that this could be set to change. Welcome to This is Deutsche Bank, the podcast looking at news and trends in and around banking and finance. My name is Victoria Garrod, and in this episode, we're talking about where Europe sits on the global capital markets map and delving into the results of our latest survey on London's clout as a listing location. Today is Wednesday, the 10th of September. Let's get started. I'm joined today by Tom Swerling, Global Head of Equity Capital Markets at Deutsche Bank, and JT, Head of Investment Banking at Deutsche Numis. Gentlemen, thank you for joining.
Hi, Victoria.
Hi.
Tom, I'll turn to you first. For those that don't know, when we say equity capital markets, what exactly are we talking about?
Yeah, so look, in headline terms, our equity capital markets business is the business unit that serves our investment banking clients' equity needs. What does that mean? We serve a different set of clients with different needs at different points in the economic cycle. But broadly, the activities fall into three buckets. So we help our clients raise equity capital, either to fund growth or acquisitions. And we do that in the form of initial public offerings or IPOs, rights issues, convertible bonds, so on and so forth. The second bucket is helping our clients sell equity stakes that they own in other companies. Often those will be positions that they own after an IPO or where they've received equity as consideration in an M&A transaction. And we do those transactionally in the form of accelerated book builds, block trades, exchangeable bonds. The final area is with more mature cash generative companies, and we help them return capital to shareholders through the form of share buybacks. And so there's a broad range of transactional activity that allows us to stay consistently in touch with our clients through the cycle.
JT, Tom mentioned how IPOs are a key activity in equity capital markets. That's when companies decide to sell shares on the stock exchange or list to raise funds for things like expanding their company, investing in research and development, or buying a new company. And advising firms on their IPO plans is a big part of your business at Deutsche Numis. Beyond the question of when to list, this idea of whether your company is IPO ready, there's also the matter of where to list. Companies can list in their home market, but they can also list abroad, perhaps in a market where there are lots of similar companies or where there's high investor demand in their specific sector. What makes where a company lists so important? And how do we as an investment bank help them to decide where to opt for?
It's a good question. And to the point you just made, for IPOs, actually the majority are in the company's domestic market. Why is that? It's because that's where their center of gravity is. That's where they generate all their revenues. That's where they're most recognized and known, and therefore likely to have more appeal to investors. But the world order is changing, as you mentioned. Brexit, for example, changed the listing landscape in Europe. It's become much more competitive. The US has always been seen as the most attractive capital market globally. And therefore, we find ourselves advising clients much more often now around a choice between each of those markets, particularly for the larger clients who have the option. And we try and give impartial advice as to which market is best for each. But to your question on why is it important for a market or a country, clearly, most of the exchanges are commercial organizations. They want to be successful. They want to attract as many issuers as possible. And therefore, they themselves are marketing to each of these companies to try and attract them to that market. And the same applies to each economy in terms of wanting to attract businesses to list in those geographies. So as we advise companies, what do they think about? What helps them make a decision? I mean, the first is where are they based? Where do they generate their revenues? If they're solely generating revenues in their domestic market, it's an easy decision. But if their strategic ambition or their strategy is multi-jurisdictional, for example, if you're a UK tech business wanting to expand into the US and maybe 30-40% of your revenues are generated in the US, then that opens up the option of the US perhaps being an option for you. And then a range of other decisions. Where are the peers that are most like you listed? What are the relative valuations of those sorts of companies in those markets? Regulatory factors. Tax factors, where's management based? Some management companies want to stay in the country that they live in and not move. And if you list elsewhere, that requires you to spend an increased proportion of your time in that market. So a range of factors, but they all combine, and we try and give impartial advice to each client around which is the best market.
Let's take a look at the UK. Deutsche Numis has just released the 2025 edition of its report, Raised in London, which surveys the sentiment and views of over 150 FTSE leaders on London's attractiveness as a capital markets destination. It's a really unique source of information, precisely because you go out and speak to such a large number of top decision makers, CEOs, CFOs, board directors. It's an interesting time to be running this survey too, as UK equity capital markets have seen a rather lacklustre period, with a lower number of IPOs and some companies moving their listings overseas away from the UK. So, JT, what are you hearing?
Firstly, it's a really interesting report, so I'd encourage everyone to give it a read. But I've tried to pick out 4 or 5 highlights, I guess, to sort of discuss. One, despite that sort of view in the media, but generally around the UK capital markets, despite that lackluster level of activity, we were actually surprised that 99% of the respondents see London as a very attractive place to raise capital or to IPO. And that's up from 87% last year. So an improvement. And this is the 3rd year of the report. And we've seen a continued improvement, which is great for the UK. Interestingly, 73 think the appeal of London as a market has increased materially in the last year, which again shows something is happening. That means London's attractiveness is, on a relative basis, is improving. And there's a number of reasons why that might be. There's been significant regulatory reform in the UK, market reform, the government political agenda around growth, pension reform. They're all contributing to London being a more attractive market. But equally, as Tom may discuss in a few moments, we've seen a rebalancing of where investors are deploying capital globally and a shift back from the US towards Europe. And I think London is benefiting a bit from that too. And listed companies are seeing the benefit of that also. So that may feed into that response. Then a few trends. The respondents say they're seeing much more interest as a listed companies in international investors wanting to invest in them. So that plays the theme I've just discussed. 83% think the market in the UK is undervalued, though. And perhaps that's why we're seeing more public to private M&A transactions in recent years. But that's more of on the concern side. But then also the respondents say they're seeing increased pressure from their investor base to think about other listing geographies to either dual listing or move their listing. So there's a natural pressure there too. So there's some colliding themes, but it's fascinating. But overall tells us that London is in good health. And hopefully we see recovery levels in activity from here.
I mentioned that things have been slightly lacklustre of late. What's behind those lower numbers? And are you seeing any clear signs of change?
Yeah, look, I think if we step back first, if we look globally over the last 5 years, particularly since the COVID pandemic, IPO activity levels have been pretty low globally. So to a certain extent, the UK is just replicating that. But what we've also seen historically is that when markets recover, the US recovers first, then Europe, and then the UK follows. And there's a bit of a lag, and Asia also comes back around the same time as Europe. So hopefully we're seeing that trend repeat itself. But certainly Brexit impacted us as a UK market. To the competition point I raised earlier, Amsterdam, Frankfurt, Paris, they're all vying for issuers to come to those markets, and the UK is battling to win issuers' attention. So that may be contributing in part, but there's been lots of positive change in the UK, a lot of regulatory reform to the listing rules, a lot of market reform. The government policies I mentioned earlier are all contributing to London being a much more level playing field relative to other global markets. And we're starting to see signs of recovery and activity in the UK as we are in the US and Europe. I'm sure Tom will touch on that in a second, but hopefully we'll just follow the normal pattern and cycle, and the UK activity levels will come back shortly.
So you're cautiously optimistic that the tide is turning. Is there anything that could help give this shift more momentum? Any changes that could move the dial?
But I think the macroeconomic picture, particularly the US tariffs, are going to be a key factor in all of this for every market. But for the UK specifically, it's particularly sentiment and confidence driven. And it's surprising how much sentiment will change if one or two deals happen and happen successfully, which I think will be important. But back to the government policy point, we've made various recommendations in the report that feed from the feedback we've had from the respondents to our survey. And what that points to is a desire for even more government policy, government incentive for issuers to either pick London to list in or to dual list here, or certainly to make existing listed companies here want to stay here. One example of that, which we're strong supporters of, is the new listing task force that the government's put in place. One of our recommendations from last year's report was to actually introduce a London Tsar, someone that is the ambassador for the London capital markets. And this is analogous to that. And I think if they can use that listing task force to push forward further reform, that will be really positive for the UK market.
Tom, turning back to you. Your role encompasses the whole world, but given our home market is Germany, I'm keen to know how things are looking in Europe. How do Europe's capital markets compare to others in terms of attractiveness?
Well, look, as JT said, the return of IPO activity in Europe is, the continent has sort of led the way. And actually, when I look at the pipeline, I look at the opportunity set, Germany will probably lead the way in the continent over the next sort of 6 to 12 months. And so the picture on the continent probably slightly more rosy than it is as we sit here in London. But I would say a lot of the themes that JT has been talking about are not dissimilar in Europe, candidly, and a lot has been written about the dearth of IPO activity in Europe as a whole relative to the US, and increasingly in recent months in Hong Kong. And I think some of that regulatory and policy reform that we've discussed here in the UK, there are also aspects of that can be improved on the continent. Really, that is about trying to make the listing process as simple and as streamlined as possible, and also to encourage more risk capital back into the market in Europe. I think there are processes underway to try and encourage both of those things. And the more success we have there, the more that will then sort of move into the second area where we still need to see improvement, which is really the level of confidence, both for issuers and for buyers, in the viability in the smaller and mid-cap area of the IPO market on the continent. So a lot of the successful deals that we've seen over the last 12 months have been the bigger transactions. That's all well and good, but we also need to see a recovery in the smaller and mid-cap space. And that's a segment of the market that's been working now in the US for sort of 6-9 months. So as I said, look, the picture on the continent probably a little bit more rosy, but still some room to improve.
We have lots of great smaller growth companies in Europe, especially in the tech sector. For example, Europe has hundreds of tech unicorns, startup companies that have reached a valuation of over $1 billion, and they all need capital to grow further. Is Europe doing enough to help them raise that capital through listings, or could more be done?
There's always more that can be done. I think, JT made a good point earlier about, international capital starting to find its way into Europe. We probably haven't seen fund flows like this in the best part of a decade. And the last time in 2013, 2014, where we really saw international money, and by that I really mean US money flowing into Europe, that was a precursor to a very, very healthy IPO environment in sort of 2014 and into early 2015. And I suspect we will see a similar sort of thing. The slight nuance in this cycle is that we're going to see that capital flow both into private markets as well as into public markets. And if anything, I think the tech sector in Europe is currently probably finding it easier to raise capital privately and stay private for longer than it is finding to raise capital publicly. And that really goes back to the point I was making earlier about some of these smaller and mid-cap IPOs. And so again, progress to be made, but the signs that we are seeing, I would say, are encouraging.
And on that note, let's look ahead to the coming months and years. Tom, as our global head of equity capital markets, what's your take on the outlook for equity capital markets, not just in Europe, but worldwide?
Yeah, look, I was in Hong Kong last week and I'll be in New York next week. And I would say sentiment in both of those financial centers is really pretty positive and particularly encouraging actually to see that in Hong Kong, because 9 months ago, that certainly wasn't the case. Look, I think equity investors are looking at the outlook. We have equity markets substantially at all-time highs. And the dynamic that people have been forecasting for the last 18 months still persists, notwithstanding, some of the volatility that was caused earlier on this year by the tariff sort of saga. And that outlook is one of inflation continuing to be managed down, of a declining downward trend in interest rates globally, of economies, even if their growth may stay relatively modest over the next 12 months, people are not anticipating contractions in the major global economies and anticipating a rebound as we go into 2026. And that is the sort of central case, I would say, that equity investors are looking at. And if that persists or if that plays out, that will be very, very benign for equity capital markets activity. And it is underpinned by sustained strong earnings growth. So we had 10% earnings growth in the US in the second quarter. And then obviously there are also some of these mega trend tailwinds behind the economy, AI being the most obvious one. And so if that is the picture that plays out, that will be very, very constructive for equity capital markets activity. We've started to see a really nice pickup in IPO activity in the US in the last couple of months. We've seen a very active convertible bond market, both in Hong Kong and in the US. And I would expect that to play through not just for the rest of this year, but into 2026, where there were a number of transactions that got delayed that were primed for Liberation Day, and we will see those transactions come back in the back end of this year and into next year. And then, as JT said, I think Europe will play catch up and the UK will play catch up after that in 2026. So I remain cautiously, or perhaps not even cautiously, optimistic for ECM activity as we look forward over the next 12 to 18 months.
Well, that sounds like a very positive note to end on. Before we let you go, I do have one last question that's a regular feature on our This is Deutsche Bank podcast. And it's, what one thing are you dedicated to within your daily lives?
Well, I'll go first. I'm going to give you two things, perhaps in the spirit of work-life balance. So in a work context, look, we are dedicated to understanding and then addressing and meeting the needs of our clients. On a personal level, my two daughters, certainly at home, they behave like their clients. So one's dedicated to understanding and meeting their needs.
I'll go with two then as well. Work. I mean, we're building a great UK business, and to continue to do that, and until we're top of the league tables from a work perspective. Personally, I've got teenage kids like Tom. I spend most of my weekends ferrying them to and fro from sports matches. So I'm a dedicated taxi driver.
I know how that feels.
And thanks to both of you for joining us today and breaking all of that down for us.
No, thank you. It's been great to be with you.
Thanks very much.
And thanks to you for tuning in to This is Deutsche Bank. If you've enjoyed what you've heard, please do subscribe or leave us a comment. We'll be back next month. And in the meantime, take care and bis bald.